People really don't know what their expenses will be because they don't know how long that they're going to live.
Americans are worried they won't have enough saved for retirement now more than ever.
Retirement is going to cost, for many folks, over $1 million.
Is no sure thing in investing, but a lot of people think that annuities may come close to that.
It's going to more safe things that they know. If they know they're going to need that money to supplement their retirement, well, then you can't play that risk.
This is the Safe Money and Retirement Show with Jon Heischman Sr., founder and partner of Heischman Financial Services, serving the Columbus and surrounding areas. Jon specializes in educating pre-retirees and retirees about safe money strategies and ideas. Now, it's the Safe Money and Retirement Show. Here's Jon Heischman Sr.
Welcome to the Safe Money and Retirement Show. I'm glad you tuned in. I'm your host, Jon Heischman. I want to take a couple of minutes of the show and talk about Social Security, a benefit that many are not aware. It's important to understand the steps and some complexities that could help you maximize your monthly checks. The majority of Americans don't know much about the program or how it fits into their retirement plan. That lack of understanding could lead to Americans missing out on using the benefit as part of their overall retirement strategy. For example, there is a benefit that could help older parents stretch their retirement income, because for these older adults who are also homeowners, have to manage mortgage payments and all the additional costs associated with homeownership, these extra funds can make a difference in retirement and provide some breathing room. A few $100s per month for many individuals can make a huge difference in closing budget gaps. We all know extra dollars coming in is one less dollar that needs to be withdrawn from retirement accounts to maintain a lifestyle in retirement. This boost to continue income is valuable, not just because it's consistent, but because it helps preserve and potentially grow invested retirement assets by reducing that need for retirement income withdrawal. It's also going to help continue income as far as longevity is concerned. All right, older parents can claim the dependent child benefit, which means they can become eligible for Social Security dependent children benefit under certain circumstances. First, you must be at least 62 and receiving Social Security benefits. If your dependent child is under 18 or 19, if still in high school, you can receive up to 50% of your full retirement age benefit. It's important to note that at age 62 is considered early eligibility. Age 67 is the full retirement age, and age 70 is when you get the maximum benefit, according to Social Security Administration. I think most people are aware of this, but if you claim at 62, you're obviously going to see a significant reduction in your benefit for the rest of your life. Waiting until full retirement age is going to give you 100% of your earned benefit. And if you wait until 70, this allows your benefit to grow about 8% per year past your full retirement age. Let's say you claim your benefit at age 63. Your benefit will be permanently reduced because you didn't take it at full retirement age, but your child's benefit is still calculated using your full retirement amount. Let me give you an example. If your full retirement age benefit is $1,800 per month, your eligible child could receive about $900, which represents half of your benefit. And this applies to more than just parents. Grandparents or legal guardians who are raising a qualified child can also receive these benefits on behalf of the child. Now, as long as they meet Social Security eligibility requirements. So I see this program especially valuable for families supporting children with disabilities, since these benefits can continue into adulthood if the disability began before their age 22. So think about this. Today, probably more so than ever, we're seeing these situations that I just discussed. And can you imagine how many people are not aware of this, that are in that situation, because they've never been told or totally educated about Social Security? So what it boils down to is Social Security planning needs to be based on each individual situation. I always want to do a more detailed fact-finding to possibly uncover situations like this, because I can help my client better and provide them with more income, which always helps. Now, those of you that may fit into this category, or you're just not sure, I want you to call me. I have helped many in their Social Security planning and uncover these situations if they're there. So we have to find out. Here's the number, 614-861-7055. 614-861-7055. We can do some Social Security planning so you can get your maximum benefit. The dependent benefit. Now, this can make a significant monthly difference and help offset costs associated with homeownership. Another example, if a 63-year-old parent receives $1,800 a month in Social Security benefits, I'm going to assume the child benefit available would be about 50%. And of course, that would be $900, as I mentioned earlier. And this would total $10,800 per year. Over the course of 5 years, this amounts to $54,000. Of course, this is assuming the total doesn't hit the family maximum gap. Now, if it does, it could potentially reduce the child benefit or other auxiliary benefits. The total of all payment on one worker's earnings record, including parent, spouse, and children combined, cannot exceed 150% to 188% of the worker's benefit. And I'm sure you're thinking, John, this gets complicated. And you're right, it does. And that's why you have to consult with a planner that knows Social Security benefits. These extra benefits that I'm referring to could be allocated towards mortgage housing cost. Extra funds. Someone could allocate them towards mortgage payments, property taxes, home insurance, or even a buffer for inflation. this benefit, extra income, can be utilized to reduce much of the parent's own retirement savings that's going to be needed to spend on housing. Another idea, eliminate debt or other expenses over time. Grandparents or legal guardians, as I mentioned, and I think this is important, that are raising a qualifying child according to Social Security receives these benefits on behalf of the child, as long as they meet these eligible requirements. If you're not sure and you think these situations may apply to you, it's worth the call. And the worst case scenario is it doesn't apply or you don't qualify for it. So at least you found out. But it very well could. And obviously, when I've given you those numbers, it could be worth making a call. 614-861-7055 is the number to our office in Reynoldsburg, Ohio. 614-861-7055. After the break, I'm going to give you some ideas on how to obtain long-term care coverage, because it's so important to address this risk and taking your retirement money to cover long-term care cost. Stay tuned. I'll be right back.
Thanks for listening to the Safe Money and Retirement Show with Jon Heischman. For more information, call 1-888-426-0177. That's 1-888-426-0177. Or visit their website at HeischmanFS.com. More of the Safe Money and Retirement Show in a moment.
With healthcare costs expected to continue to increase faster than the inflation rate, the time to take a look at your future healthcare is now. Not in retirement, but if at all possible before retirement. If you've already retired, it still isn't too late. A lot of the cost can be controlled. We work out a plan how to cover the increased cost that we're all going to be faced with. And believe me, I think it's probably going to be the number one increasing cost that we're all going to see in retirement. You want to talk further? You can give me a call. 888-426-0177. 888-426-0177.
Life expectancy is at all-time highs, so that means you've got a future to plan for at any age. If you have longevity in your family tree, then you need financial education from someone with the experience and knowledge to guide you into and through your retirement years. Jon Heischman and the folks at Heischman Financial Services are committed to helping you achieve your retirement goals with a low-key and trustworthy approach. Call Heischman Financial Services today to get started on your retirement future. Call 1-888-426-0177. That's 1-888-426-0177. Heischman Financial Services has your future in mind.
Welcome back to the Safe Money and Retirement Show with Jon Heischman. To contact Jon, the number to call is 1-888-426-0177. That's 1-888-426-0177. Once again, here's Jon Heischman.
This is Jon Heischman. I'm back with the second part of my show. Thank you for staying tuned to Safe Money and Retirement. One thing I do want to mention while it's on my mind is required minimum distributions. Don't forget to take the 2025 distribution if it applies to you. Currently, age 73 is when you have to start taking distributions, and that's the year that you turn 73. You may want to consider having that distribution set up to where it's automatic. Each year, the custodian of your IRA or 401k, if it applies, figures the amount for you and distributes that to you. That way, you don't have to worry about getting it right, taking the correct amount, exposing yourself to a tax penalty from the IRS. November is the largest payout month for required minimum distributions, and I think probably because many want to get that check for holiday spending. So don't forget the required minimum distribution for this year, 2025, from your qualified plans. Also, I can show you how to combine IRA accounts into one or two. I know many of you have multiple accounts, and I say that because of experience witnessing from those I meet with. There's a good chance you have two. And as I mentioned, possibly more. So we combine those into one, or like I say, two, depending on what type of investment suits your needs and risk tolerance. Let me know. I'd be glad to work with you and show you some options. Try and keep things simple and growth and more potential income in retirement. 614-861-7055. 614-861-7055. The first part of the show, I mentioned I would be discussing long-term care and why that is so important for retirees and why it needs to be part of their plan. I think I have a list of 13 retirement risk. And if you'd like a copy of that list, just call the number that I give you and leave a message or ask for me to have that sent to you. But anyways, the two biggest retirement risk is longevity and long-term care. And I think most retirees are concerned about the longevity risk. Will your money last throughout retirement? And those of you that are regular listeners, you know we can solve that risk problem because I've talked about it many times over the past years as far as generating guaranteed lifetime income that you cannot outlive. But what about the long-term care risk? That is a health shock that drives the need for expensive long-term care, which often arises suddenly and frequently on a permanent basis. Now, this makes the prospect of serious disability in retirement one of the biggest sources of stress for late career workers as they map out their future income strategy as well as those that are in retirement. So if we look at some statistics from the National Bureau of Economic Research, nursing home cost could exceed $100,000 per year in many regions, and government assistance programs, which would be Medicaid, they only help when retirees are basically destitute and have no money or have spent down their assets for long-term care. So the long-term care risk and longevity risk go hand in hand, because if you haven't planned for the cost of long-term care, so many times individuals have to go into their retirement accounts to pay for long-term care. So what happens? Retirement accounts that are going to generate income are depleted in order to pay for long-term care. Obviously, you're using money that is going to pay retirement income for the future, the rest of your retirement, or taking away from funds that need to be used for income going to your spouse. So we have a double problem here, and your retirement plan has just depleted. Now, I know what you're thinking, as pretty much everyone thinks about, is the cost to provide long-term care coverage. And believe me, I agree, I understand, because I know what a long-term care policy costs, and the majority of retirees cannot afford to pay that premium. The other problem is you have to qualify for a long-term care policy from a medical standpoint. Medical questions are asked on the application, and overall, you need to be in pretty good health to qualify for an actual long-term care policy if you can afford it. So as we all get older, the chances of qualifying for a long-term care policy from a medical underwriting standpoint decrease. And then we think we should have bought that policy back when we were in our 40s or 50s, when the premium was low and we were in good health, and many do. But the majority don't, because long-term care costs are the farthest thing from their mind, as is retirement in a lot of situations. So what's the alternative? Well, one that I think is amazing as to what the companies are doing as far as using an annuity contract with a long-term care rider that could pay out for long-term care coverage up to 2 times, 2.5, or even 3 times the annuity amount for long-term care. Let me give you an example. I take $100,000 to purchase an annuity, and this is a tax-deferred annuity that will have potential growth. Where does the $100,000 come from? It could be from savings, a CD that's matured, or an old annuity or 2 annuities that can be combined into one that transfers over into this annuity, equaling $100,000. Now, I'm just using this as an example. It could be more. This new annuity has a long-term care rider to help cover the cost of long-term care. There are no future premiums, and if the long-term care benefit is not used, the account value with potential growth is yours or paid out to your beneficiary. This particular plan continues grow in popularity each year since it was designed. And you can see why. It can complement a long-term care policy or a self-funded long-term care plan. Now, this may help with your long-term care planning. And of course, the only way would be to find out for yourself. I can provide you with information or speak to you about how this can be designed for your situation. 614-861-7055. That's the number to reach our firm, Heischman Financial Services. Again, 614-861-7055. I think you owe it to yourself to check this out and how it can help you. It may not, but then again, it might be something that will complete your plan to also help save your retirement income. I want to thank you for listening and hope you continue to tune in to the Safe Money and Retirement Show. Again, let me know what questions you have. If you'd like some information, and there is no cost, there's no obligation for requesting any help that I can provide you. I'm Jon Heischman, and be sure to tune in next week at the same time.
The Safe Money and Retirement Show with Jon Heischman Sr. To get in touch with Jon, call 1-888-426-0177. That's 1-888-426-0177. For more information about Heischman Financial Services, visit their website, HeischmanFS.com. That's HeischmanFS.com. Join us again next time for the Safe Money and Retirement Show with Jon Heischman Sr.